Hey, everybody. Welcome to the Real Estate Note Investing Be the Bank broadcast. I'm your host, Justin Bogard. And today is Wednesday, May 13th, 2026. We have Jay Redding and Dan Deppen on the call today. And I have downloaded the latest Mortgage Monitor report to go over some of the information in there and ask the guys some questions. So stay tuned. Well, gentlemen, I am back.
All right. Welcome back.
Hopefully you didn't miss me too much since the April broadcast. Miss my shiny head.
I gotta say,
Yeah.
I'm with you, baby. I'm with you, Dan. You gotta catch up, man. You gotta hurry up.
Got a little ways to go.
Dan's got the summer cut going, man. He's looking
Yeah,
a little tight
he's
there
got
with
that.
his cut.
You got the
They just
tight
got a cut
looking.
yesterday.
Yeah, man.
Yeah.
Looking fresh. I like it, Dan. Well, if anybody has a question or comment throughout the broadcast, please chime in on whatever social media platform you're on. Or if you're watching this on our American Note Buyers YouTube channel, we'd like you to chime in, maybe where you're at, where you're from, or any questions that you have that may pertain to the subject matter that we are talking about today, or it could be any subject in general pertaining to real estate or real estate note specific. And we'd like to answer that live on the call today. Since it's just the three of us, we have a little bit more time. So how are you both doing this evening?
We are doing good.
Yeah, doing pretty well. So
Yeah.
Keeping at it.
Yeah. Have anything interesting or detrimental or exciting happened to either of you the last week or so?
Yeah, I've had a few interesting things. So I'm in the
Yeah.
process of buying a portfolio of land contracts. So this will be the biggest single purchase I've ever done. So this is a little bit of a new
Nice.
one for me. And then I've got an REO that got listed for sale last Friday and in Oakland of all places. So yeah, crossing my fingers on that.
Yeah.
Hopefully that goes well.
That's awesome. So I think this is the one we've talked about offline, isn't it?
Yeah, it is. Yeah. Yeah, there'll be a case study at some point in the future when it's all said and done. But
Yeah, that'll be nice when it finally plays out and you get that
Mhm.
check, that
Hopefully.
wire, I should say.
yeah, it'll probably hopefully be a wire.
Yeah, I've got 3 REOs on the market right now, and I don't have any offers on any of them because they're kind of fairly new. Actually, one of them is kind of seasoned, and the other 2 are just now getting on the market. So hopefully I can sell those outright to an investor or have them be seller finance. So I do have language in there to entice someone to have me carry back a loan for them. So
Do you
hopefully it'll-
use agents for your REO sales or do you kind of do it yourself?
So I typically am just using agents to help me, and I try to find an agent that's more investor friendly savvy, so they kind of understand that there's a seller finance aspect to it. One
Mhm.
agent in particular actually sold me a couple of seller finance loans they did several years back. So using that agent was nice because they're already familiar with the process and they know how to kind of pre-vet the borrower and kind of get them down the path of like, yeah, if you don't have $500 to your name, you really shouldn't be buying a house right now. Kick the can down the road, with someone else.
So
Yeah, I do have a duplex in Indianapolis. I don't think I'll be able to seller finance that one. That'll probably just be like a landlord DSCR type loan purchase. But that would be pretty cool if it was a loan that I could provide some financing for. I definitely do that with a larger down payment than a consumer would put down. So
Yeah, the problem I run into with a lot of my REOs is by the time I get them, they're pretty beat down, so that they're not they don't necessarily like make sense for a retail type
yeah,
borrower. So it ends up being more of like an investor buyer.
I'll have to put a little bit of money into this duplex. Hopefully, no more than $10,000. just because it needs a little bit of help with what I would call some major things that are defects right now that another buyer may add on 20 or 30,000 to lessen the value, as opposed to me trying to fix it right and doing it for an economical price and, being able to sell it with some value. I do have one land deal that's an REO, and the other two are single family. Well, one's a duplex, one's a single family. And then I got another single family coming to the REO market, hopefully in the next month or two.
It's weird how many people are defaulting these days. I have a handful that are in various states of foreclosure, which I don't quite get.
What
These
do
are
you
people
think
who
the
made it
national-
through. Go ahead.
That's in the market.
No. Finish your thought.
Well, no, I was going to say, like, just a lot of these people made it through COVID and everything else and have been around for a while, and they're deciding, like, now to go
Well,
red
the
on
reason
it.
is because the government finally quit kicking the can down the road. That's part of it.
No stimmy checks or whatever.
No stimulus checks have come back in. So, and then the inflation has continued to increase. So, yeah, there is a fair amount of stress in the market. There's no question about that.
Yeah, I think people chew into their equity too quickly when rates were low, and now they're stuck with payments they can't afford because of the cost of living has just gone up so much, in different markets. And especially the markets that got real hot, they've kind of cooled off quite a bit.
Yeah, they have.
And so now they haven't raised any value really since the 21, 22 time frame. And so they just came kind of stagnant. So I can see why people are struggling. Along those lines, since you brought it up, Dan, the Mortgage Monitor report came out. It's a monthly report I used to do all the time on this show a few years back, and I kind of stopped doing it because we got past all the COVID stuff, and it wasn't really that, it wasn't that fun of a report to look at because it was just stale, just kind of the same information.
It's
it really
boring.
Didn't change a whole lot.
Everything's the same. It's boring.
Yeah. So now I look at it, and it's kind of interesting, so you see some blips here and there. I'll share the screen here if you guys don't mind, so I can show. Hopefully this comes up large enough, but this is doing a look back since 2000, actually September of 2000, all the way to 2025 of September. Okay. And the black line indicates the FHA line. And if you guys can't read it, I'm just trying to read it for you. The VA is the light gray line. The conventional loan is the blue line. Mm-hmm. And the green is kind of, I guess, an average or a mean of all that. So surprise, right?
No surprise
FHA
here.
was definitely a highly defaulted paper in different times, as you can see. In the late 2019, early 2020 timeframe, you can see it just went up significantly, over 13% as a delinquency rate. Not default rate, but just a delinquency. So right now it doesn't look too uncommon. If you allow me to scroll back, I wanted to see what
It's interesting that both VA and FHA have the highest default rates. One can be 0 down, the other one's only 3.5%. And that's one of the reasons why we always encourage to get large down payments that your borrowers have skin in the game. The more skin in the game, the less likely they're going to default over time.
So I want people to be aware that are listening to this show, even though you hear things and you sense things on social media and you may see headlines, our national delinquency rate is nowhere near where problems were in the past, right?
That is very correct.
Yeah. We all agree that foreclosures are coming up. Well, guess what? We've been well below the foreclosure delinquency type rates for a few years now. Mm-hmm. So we are not even to looking back the historical average, really. We're at 3.35%, and the historical average around this time, because of seasonally, it's 3.91%. Mm-hmm. Now it's a little bit lower this time of year, obviously, because people get tax refunds back and they end up getting caught up with stuff, so they're not as delinquent. So this is the end of March data, not including April or anything that's happened in May so far.
Okay.
And I think that makes sense just because since the financial crisis, underwriting standards tightened up so much. You had the COVID blip that was its own thing, but even like compared to probably before things got super nuts
Yeah.
in the early 2000s, it's just been a lot tighter. So that's why we haven't seen that
Yeah.
overall go that high.
Somewhere in this report, and I know you guys don't want to see a lot of scrolling here, there was a section that said a lot of the current defaults are loans that were originated after 2022, as opposed to loans that were originated before 2022. So I thought that was kind of interesting.
Yeah, I think to your earlier point, that's just because in some market, like especially we're in Denver where I am, like I think like values are down since then, since the high point. So
Yeah.
and there's been a lot of inflation as
Yeah.
well. So
So I was going to try to scroll to find a different forecast here or a different look back. A lot of that stuff's just the same thing, looking at it through a different lens. They have foreclosure, defaulted loans like in foreclosure or out of foreclosure or going through foreclosure versus just delinquent loans that are just, behind 30, 60 and 90 days. So if you don't know already, after 90 days, we kind of consider a loan non-performing at that point when they've missed basically 3 payments. And then foreclosure typically starts, quickly after that.
Mm-hmm.
Unless a lender is just being slow about it, which there are some lenders that are slow about it.
This lender isn't.
The J. Redding lender?
The J. Redding lender is not slow about that.
I'm not either. I typically have a daily routine of looking at where things are at in my timeline, and I'm moving the needle as much as I can every day that I can.
Yeah.
And it's usually I'm just waiting on the attorney to finish whatever part that they have to finish. And they're usually waiting on the county to accept whatever it is that they're uploading to the system. Okay, here's a good one. This pocket doesn't surprise me here because that's during the moratorium.
Gotcha. Okay.
So that makes sense.
yeah, and courts were closed and stuff in different cases.
But I think this is what I was talking about. The defaulted loans are in green here in each graph, and those are the 2022 originated loans going forward. You can see how they're kind of growing, and it kind of just reiterates what we were talking about earlier about those markets and stuff. I don't know if it breaks down where those are at in different markets. The report does a good job, and by the way, anyone can go to ICE. I forget what it stands for now. Do you know what it is, Jay or Dan?
No, I don't.
Okay. So it's
just the immigration's not in there anywhere.
What?
No, it's not that.
Okay.
It might be international. I'll have to look it up here once I get done scrolling. Oh, they always show the 30-year mortgage versus the 10-year treasury yield spread. So it's kind of interesting. The gray bars in the background, that's the delta between the two lines, the blue and the black. So I kind of leave it up there for you to look at. There's a correlation or proportionality to it, but it doesn't follow it exactly, to the thousandths of a decimal, but it kind of goes along with it a little bit.
It tends to run parallel with the 10-year treasury.
I think sometimes it just has to catch up with the other one.
Yeah.
When something happens. But I don't remember the 10-year treasury being that high several years back. I guess I just didn't pay attention to it or document it. But
well, that only goes back to 2025.
Right, but I'm thinking like
graph.
In my brain, and when I was looking at this more like in the 18, 19, 20, 21, 22, like I feel like it was much lower.
That's when they were like zero.
Yeah, basically.
Very low. Yeah.
So anyways, this report's kind of cool. It's called the ICE, the Mortgage Monitor Report. It's free to download. You don't have to put in an email address or anything. You can just go to their website and click it and download it. Like I said, once I hop off this page here, I'll put that in the chat notes so that anybody can go and check it out. It's a long read, but it's very, very well done with research and data. The other company I like to use, I know we've talked about this offline, is the John Burns data.
Good stuff.
That's always very well done as well if you want to kind of see what's in the market.
John Burns Research.
Thank you, John Burns Research. So they have a lot of different graphs in here. Some of it's more pretty visually, like this one. And some of it's more, you have to kind of look at it and study it to really understand what it is it's saying. And a lot of it makes sense from what you feel and think about what's happening. So, yeah, I'm not sure if there was anything else I wanted to bring to your attention.
Hey, scroll back up to that other one. It's interesting how the refinance activity kind of collapsed in recent years. That's why now there's like a lot fewer people with mortgage licensing. People just kind of exited the business when the refinance gravy train.
Yeah, it's kind of like realtors are starting to fade away too.
Yeah, which is really funny because there's other alternatives. Like,
yeah,
I don't know if this probably doesn't have anything on non-QM lending, but like that's exploded. But it's just funny how some people in the industry, like, they find their little thing, and when it stops working, they go away. When there's usually like something else you can just sort of pivot to that's very adjacent.
Yeah, sometimes people get into the business at the tail end of its heightened state, if you will.
Mm-hmm.
Like mortgage brokers, a lot of people got in like towards the end of it, and then all of a sudden mortgage originations went down quite a bit.
Just dried up almost overnight.
And then there's me starting a mortgage brokerage like in the teeth of the downturn. So then there's me.
Well, you're just getting ready to ramp up for future.
I'm gonna say you're ready for the next opportunity.
Put it on the shelf, Dan, and just kind of keep it there. All right,
I'm not putting it on the shelf. I'm going. Yeah,
full board. Yeah, I've noticed a lot of because there's not a lot of activity on the market for houses to be sold. A lot of agents, or at least part-time agents, I'll say, they struggle and they get out of the game because they just can't. They don't have the luxury of when you couldn't make a mistake 5 years ago selling a house because you look a week later and it's already appraised another percent.
Yeah,
like that was a good time to get into real estate, to be a realtor quickly, because you can get in and make, I wouldn't say easy money, but you can make easier money than being in it now. For sure.
Well, and I've looked at statistics on both mortgage brokers and agents. And if you look at the distribution of like who does all the business, there's definitely like an 80-20 rule that applies. Like, the top whatever percent do the vast majority of the deals, and then it kind of drops off. So when things get tight, like the tail like really drops off.
Yeah. Usually at the end of these reports, I'm trying to get to without passing over something that's really cool. They have like a breakdown of where the defaulted loans are at by like state, and they do different statuses.
I saw the Indiana on one of the reports that I follow. I don't even remember which one it was. I saw Indiana was one of, if not the highest, one of the highest.
Here we go.
And I know Florida's kicking up, especially Cape Coral for some reason.
Cape Coral, definitely. Yeah.
April 25 to April 26. This is your annual home price growth rate.
Okay. Interesting.
So I will show you the actual list here, but I just want to see the spotted graph across the country so you can see what's happening in certain areas. Probably certain markets you're not surprised because they were overinflated to begin with.
Yeah.
It's interesting. Everybody's all about the Rust Belt.
Well, yeah, it's a typical pattern. I mean, everything, I've seen this for years. Everything happens first on the East and the West Coast, and then it gradually, and then across the South, and it gradually comes into the West. We're growing because we didn't have, we had to run up, but we didn't have the explosive run up nearly as much as like, Austin, Texas, or places in Florida, et cetera. And traditionally that's made it really good for rentals, but now everything's out of whack as far as pricing on the real estate, that the rents just haven't kept up with the inflation and appreciation of the rentals. All right. And it's a squeeze for many landlords right now is taking place, but this is just the normal pattern. It will continue to grow. And typically also when everything starts to go downward, we tend to hold longer before we do start going down, and we typically don't go down as deep as far as what we saw in the Great Recession for us old guys who lived through that.
All right. I know the answer to this question because I've seen this in the report, and I think it's kind of funny, and hopefully you guys will get it if you've seen, if you can get my hint here. So the city and state with the highest annual home price growth rates on this report. I'll give you a hint. There is a fictitious paper company there.
How about Scranton,
Yeah.
Wilkes-Barre? My
You got
great
it.
aunt
Scranton,
used to live
Scranton,
there.
Pennsylvania.
Yeah, I've been there.
Yeah,
That's really random.
It is, yeah.
I would never have guessed that.
And then Milwaukee, Wisconsin. Surprise, surprise. That's good news for me because one I'm going through foreclosure right now is in Milwaukee, Wisconsin.
Ah, there you go.
So yeah, so there's your top 15 little markets. If I remember correctly, during
Youngstown, Ohio. There you go.
Yeah,
Toledo.
Toledo.
Yeah.
during the modest appreciation several years back, Chicago was kind of just normal. They didn't fade a lot. They didn't grow a lot. And now they're kind of hitting the stride right now. Surprise, Rochester, New York is in there for appreciation. Quite a few Connecticut's. Cape Coral, I think someone mentioned that earlier. They're down quite a bit.
Yeah,
They're
I
down,
mentioned
yeah.
that. It's interesting. Palm Bay is on that list. That's right next to where I grew up. I know that area
Right here.
pretty well. Yeah. And then Denver, where I am, we're kind of a mess.
Like I say, got a lot of Texas in there that's all slowing down.
Yeah.
And I think that's because of what you said before, Jay. They had such a ramp
Yeah.
up.
Is this the Oakland area here?
I hope so.
I want to hit the one blue dot in California for you. Okay, so that's a fun little chart. Anyways, you guys can check that out. I'm just going to scroll quickly down just because I don't want to spend too much time on this. Down to the statistics here. So, I thought they gave a state breakdown. Oh, there we go. Non-current loans by state. So you have DQ for delinquency, you have FC for foreclosure, and NC for non-current.
Okay.
So
This is through March. This date is through March, correct?
this data, yeah, exactly, through the end of
Okay.
March. So this is just the month look, not like not like a whole year.
Yeah.
So the delinquency is just somebody that's more than 30 days past due. The foreclosure is actually what is actually starting foreclosure, and then the non-current is like both of them combined. So where's Indiana at? They're probably over here.
Number
yeah.
4.5.
4.7, 5.47, 8.7% year-over-year change in non-current.
Okay, so I always see, all right, year percent change. All right, so we could have been really low last year, and all of a sudden, because we've increased some, that can skew that percentage. But the delinquency rate, that's a more accurate feeling.
It's interesting that Colorado's delinquency rate is still at the bottom, despite values going down more.
So, okay. I just want to share that with the audience there and let everybody see that. I'll go ahead and look up the report in the background of actually where I got it from. But Jay, what do you have anything, in your business that has given you some excitement, some grief lately?
Well, it's been really busy for me for the last couple weeks, that's for sure. I was down at DME, all right, in Nashville. I spoke there, and then that was on Friday, and then I flew Friday night down to Atlanta and spoke at the Creative Finance Summit in Atlanta, and then from there I flew to St. Louis on Sunday, and we attended. Kyle drove from Nashville to St. Louis. I flew from Atlanta to St. Louis, and we did our leadership boardroom retreat there. And I just made a presentation last night to our local RIA, all right, on underwriting fix and flips and to a large group of newbies, but fix and flips and also rentals and also highlights on seller financing and different strategies in that respect. And I'm flying out tomorrow morning then to go down to Dallas for 4 days of meetings as well. So, and in there we've got bids in on three notes. Hopefully we'll get, and 3 partials, and we're looking at another list, a portfolio out of Texas right now, and doing some due diligence on them and see if we can pick up 3 or 4 out of that group as well. So we'll see. So that's kind of where we're at.
Sweet.
And busy.
Sounds like you are definitely hitting a lot of places.
Yes. So
you being in the office right now is a rarity.
Right now, so the last 2 weeks, that's very true. Then I'm kind of done for a while. Things settled down for a little while then. So we have a couple NPLs. We got a couple that's going through foreclosure right now. We got one in Texas. We got one in Michigan. All right. So those are moving right along. I may have another one. We have filed for another one in Michigan. So we'll see. That one's in my IRA, but we'll see how they progress. And yeah, we'll just see.
Well, for those of you that are looking at the comments, I know it shows up on the YouTube channel for American Note Buyers. I posted that URL for you in a comment. If I flash it up on screen, you'd have to type in like 300 characters worth of URL data to enter it in. So hopefully that works for you guys. I'm not sure if it shows up on Jay's what you're sharing.
No, I see it. I see it.
So just wanted to point that out there. Okay. So personal guarantees. I wrote a post about this a few days ago because it's something that I haven't really heard a lot of people talk about. And I've just ran into some situations personally with some deals that I've done before to where I thought that it sounded good until I realized that the person that was trying to guarantee it in certain forms on a document, they really couldn't perform on that guarantee when it came time for them to pony up. So I am now focusing more on structuring a deal to where the person selling me, like either a portfolio or a note, kind of has some residual interest in there, or there's some sort of purchase holdback to where I've got to see a little bit more performance if I feel like it's necessary to mitigate some more risk. So
do you mean like the participation type strategy where they're still in it, or?
That could be one. Yeah. So I could split the cash flow with them, buy so much, let's call it 70% of the cash flow, and they keep 30%. So it lowers my exposure, but it keeps them in the deal to where they're motivated to help me out if something goes bad. Maybe I hold back some money at closing and say, okay, I'll give you 90% of what I said I would give you, and I'll hold back another 10% for maybe a year and a half, 2 years, just to see that the borrower's performance is going the way it's supposed to. Or perhaps it's a situation to where they need to make some more updates to the house and they have every intention to. And so perhaps I hold back some money for that. Maybe the seller, I have them put money in escrow so that I pony up all the money up front, but then some money is held in escrow to where it doesn't get released until certain things perform the way that they do. And if anything defaults on there, at least I can recoup some of that money back and I can have a lower exposure into the deal. So there's quite a few things that you can do if you get creative enough. So I am now approaching it that way, as opposed to like a personal guarantee on someone, guaranteeing a loan or saying they'll buy it back. Because I just know in the future, it really depends on their liquidity and their situation. And you don't know if they're going to go bankrupt, 5 years from now or even be in existence. So that's just kind of why I wrote the post. And I'm sure you guys know of smart ways to protect yourselves as well. But just want people to know, like, just because somebody says, I'll personally guarantee it. Yeah.
It's only as good as the assets that you have.
Well, it's a collection remedy. It's not a actual security in the deal.
No, it's not.
Yeah.
So you could be chasing them for years to ever get it.
Yeah. You're just going to go through litigation, and nobody wants to go through litigation. It takes way too long and it still costs you money. So
yeah, it seems like it'd be more expensive to collect it then it would be worth. And even then, if they don't care, they could just file bankruptcy and
Exactly.
which, yeah, for a lot of people that'll stop them from defaulting, but some people not so much.
That's one of the reasons why we don't go above 70%.
Well, it's another good reason why you do partials, Jay, is because they still have a residual interest.
They have a residual interest. It reduces our risk, and that is specifically why we do a lot of partials, to help offset that risk.
Yeah. I wish more sellers would be open to partials. You just don't find a lot of sellers that want that as an option. And I can understand why from their standpoint, especially if it's an LLC, they really don't need to be doing a partial. They can do other methods of recouping
Well,
capital.
it depends. Yeah, it depends on what their goal is. Okay, if all they're trying to do is just recoup their capital to get as much as their profit now because they need it for overhead, etc. All right, that's fine. I get that. All right, but if you're really looking for long-term wealth creation down the road, you sell a partial, and when that comes back to you, say you sell a house for 145,000 or 100, we'll say 150,000. I come and buy a partial, all right, get you out of the deal, all right, put a little money in your pocket now, not as much as if you were selling the whole thing, but you're making some profit now. When that thing comes back to you, because of the difference in the amortization schedules, you're going to make more than 150,000. You're going to make close to 175 to maybe, depending on the terms of the loan, it could be as high as 200,000 out of that loan. And the only thing that you had in that deal was you left a little bit of equity in the deal. You had all of your money out. That's the play. That's the wealth play for the long term.
Yeah, we all get that. I mean, I'm just saying there's very few LLCs that want to do that, and that doesn't make sense for them to do that as a business. There's only been like maybe 2 LLCs that I've ever worked with that even would consider doing that, because it's just their own money they're using. Most people need the development money back into the company so that they can keep making deals and stuff.
Right. These are situations where we take out private lenders underneath.
Yeah.
Yeah.
So like if they have notes in like an IRA and stuff, well, absolutely don't do anything but partials and that stuff.
Yeah.
But when it comes to an LLC, it's just a little harder to find somebody that actually has the capacity to do it. Now, if they had 50 notes, yeah, that's easy for them to do a couple of them like that.
Yeah.
But if they're trying to do all their loans like that, I don't see how it's possible.
Well, not every deal is going to fit, but it depends on what the volume that you're doing. If you're doing 5 or 6 of these in a quarter, one deal a quarter, putting back in the back for long-term wealth is not unreasonable and can pay high dividends in a few years.
It's easier said than done, because I'm finding that a vast majority of these operators they're way over levered. So the partial technique doesn't even register to them. Like they need like 80 to 90 cents on the dollar just to be made whole.
Yeah. And they're the problem is they're getting into the deals way too high.
They don't want to put their own money in the deal. That's the problem.
So
they want to borrow everything and not have any real skin in the game.
Well, and the reason for that is if you do enough, you run out of money at some point, no matter who you are. So you get driven to that. Yeah.
But I'm saying you're getting into the game. You've got to be all in at 70%. If you're above that into the game, into the purchase, etc., that strategy is not going to work. Okay. And there's too many people that's violating that rule right now, and they're going to get their, clipped. That's what's going to happen in time. I've seen it before.
It's been happening. Like it's ridiculous. That's why I say that. Like I can say it with very high confidence that a vast majority of the developers making loans because they're fixing and flipping houses or buying them cheap and fixing them up. They're still way over levered because they want to keep pulling equity out for cash as much as they can because of
just to survive for them.
That, and I think it's the lifestyle that they choose to live.
Yeah. Well, we don't necessarily work with developers. We're working primarily with house buyers that are selling on seller financing. Okay.
That's what I'm talking about too.
Yeah. So
and those guys that's who I'm talking about, is those guys.
I had a discussion this afternoon with an individual out of Texas, and he writes really good notes, and actually some banks buy some of his notes, and we can't compete with bank money. I mean, that's cheap. All right. But there are certain situations where we can be a relief valve for him, and he readily admitted there are times when the bank's not going to take it, they're not going to buy that, and we need to get out for a certain reason. So those are opportunities that we make available. That he's got another resource for recapitalization. So
Yeah, that works out great.
So
get the trickle effect.
Yeah,
Stuff that trickles out of the bucket.
Yeah, I mean, we're not a bank, so the cost of our money is higher than what a bank is. And if you're writing good enough paper that you can sell that to a bank, then fantastic. That's great for you. But not everything that they do is going to fit that model. All right, we fill that gap of when there's people that's not buying for whatever reason, okay, that they don't and they need liquidity. We can provide that liquidity.
Yeah, that's why I encourage people when they're creating loans to create bank quality.
Yeah, agreed.
Paper, because when they need to recapitalize, that's where they'll do the best.
Yeah. And if you're creating crappy loans, all right, your options to ever get out of that are exceedingly low because you're going to take an unbelievable haircut because you didn't do the things that need to be done.
And they don't like to hear that.
They don't like to hear that, but once you make the pie, we can't change the pie. You didn't do the things that you didn't put the right ingredients in. Contact us beforehand. We can help you create a better pie so you have better options available down the road.
Yeah, because if you create a good one, like the secondary market for high quality seller finance loans is bananas.
It's good
because they're basically, they're basically the same as like a non-QM loan is pretty much like a good quality seller finance loan. And those things I just saw the latest data from Rams. There's a guy that they sometimes facilitate these portfolio purchases of like newly originated non-QM loans. And they're selling for like around 102, 103 cents on the dollar.
Yeah.
When they're well originated.
That's institutional.
What's the coupon rate on those?
I think like 7-8-ish. I don't know.
So they're netting about a 6 to 7% yield on those.
Yeah. Probably something like that. Probably somewhere in the 7s. And I asked them, I'm like, why are these trading for so much? And it's basically the institutional demand outstrips the supply. And you've seen the non-QM market, like ramp, it's up like well north of 10% now, like trying to meet the demand. So so if you make a good seller finance loan, you're basically in that bucket.
Yep.
That's awesome. I was going to mention something else that I ran into earlier, and I completely spaced what it was. I was going to have you tell you guys. Anybody else have a thought that you want to share?
Yeah, I've got one. I don't know how much of a thought it is. It's just sort of a new situation for me. But like you guys, I've got a handful of foreclosures in various, areas of progress. But this is the first time I'm ever going to complete a foreclosure from second position. Like I've started them before.
Ooh, interesting.
But I've got an auction coming up at the end of this month. The borrower's already been through the whole bankruptcy thing, so they can't do that again to delay it. So it'll be kind of interesting to see how this goes down. There should be quite a bit of equity based on when the first was modded a couple of years ago, even if they went completely red on it. But I've completely failed to actually get like a confirmation on the balance of the first. So I'm interested to see like what bidders do at the auction. Like if I can't figure out the first balance, they're probably not going to know either. So they just not bid? Is somebody going to screw up and not realize there's like another lien there in place and bid more? Or, I mean, really it wouldn't hurt my head if it doesn't sell at auction and I end up with this property subject to the first loan.
What do you think you'll do if you take it back to start paying the first loan? Or
yeah, probably. I mean, probably the initial thing I'll do is start paying it. I'll talk to them, say like, hey, like, I guess I'm your borrower now. Hopefully you can tell me what the
I'm gonna say, have you
Status
gotten any response at all from them?
Zero.
Nothing.
Yeah.
Is it a bank?
I believe it is. Yeah, no, yeah, it's it's not a bank, but it's one of the bigger like lenders
Oh,
in the country. I forget which one it is. I think it's like Mr. Cooper or something like that.
Okay.
Maybe. But,
Okay.
but yeah, I'll try to figure out the status of the first and, the condition of the property, and then I'll kind of see what makes sense. I mean, the underlying loan has a really low interest rate. It would be kind of sweet to sell it on owner finance and just wrap the one
Mm-hmm.
that's there. That could be potentially lucrative. Or if all else fails, I'll just sell the property. And
because you don't know how far behind they are on payments or what the arrearage account is either, right?
I don't. I just know that the first has never started foreclosure, and they did a mod like sometime back, so I know the status like a couple of years ago. Their payment on that is pretty small, so
Nice.
I kind of have a suspicion they may have been making payments on it because they never started
Sounds like
foreclosure or anything.
if they didn't react to your foreclosure complaint, you think they?
Yeah,
you figure they would have.
I would have
maybe
thought
they
they would have responded.
getting paid, but even if they haven't been getting paid or they're somewhere behind, there should still be equity in it. So I suspect the best outcome for me is nobody bids at the auction and I just get it. But I mean, if somebody does, then I'll get a full, I'm bidding my full payoff
Sure.
on the second. So
Do you think
We'll
the
see.
house is vacant?
I don't think so, but I haven't checked in a while.
You just check the mail if it is vacant. See if you got a mortgage letter from the first lien.
Or just have somebody go by and get the mail. I
Yeah, if it's vacant.
I think that's illegal. Well, it's probably still illegal, but
Once you own
I'm
it.
not going to do that.
No, once
Once
you
you
own
own
Once
it.
you own it. Okay.
Yeah, once you own it. Not
No,
Yeah.
check the
not
mailbox once you
until
own
then.
it. I'm on record here. I'm not trying to commit
Yeah,
a crime.
yeah,
Tell Dan to commit
exactly.
a crime. I'm
We'll have to
saying
do a special episode on
Wait till you
the
own
dark
it.
arts of notes with Justin. Yeah. the
There you
dark
go.
arts of
I'm already on the bad list here.
Oh, jeez.
I
Yeah.
I have a borrower that is just habitually late. Like they'll get caught up to 15 days behind, and then they'll get as far as like 85 days behind. And finally they got past 90 days behind. So I could, start a foreclosure complaint and send them a demand letter and all that stuff. And so we give them a good through date of like 30 days to say, if you're going to reinstate the loan, here's what you need to do to bring it current before this date. And then, you have been forgiven and we can just move forward again. So we give this person the good through date numbers, and like 3 weeks go by and then they send in a check after that. And we're like, no, we can't accept that because now there's more cost added to the loan because I had just paid taxes as well. So I was like, I have to add more to it. And then there's another 30 days out, then another payment that they missed. And it's just like, they just get themselves so far behind. So finally today we were on our third good through date reinstatement, what do you call it, report or statement, I guess. And I'm still like working through foreclosure in the background while this is happening. I'm just like, okay, this is like the last time we're going to do this reinstatement thing because they're just not getting it. Like they just don't look at the date and be like, this is a deadline. Like if you want the loan reinstated and not have more cost added, like just be able to pay it off. If you can't pay it off, then work with us. But sometimes it's just so challenging to, have the borrowers work with you to figure out a solution.
Are they communicating at all, or is it just
They do speak mainly Spanish, and they are able to call in to a Spanish speaking representative at the note servicing. I think I'm using FCI with this one.
Mhm.
So their thing is I think they say they don't have email and they don't have a way to fax or receive like this stuff. So they have to go through like a different way that they do it. It's just really odd. It doesn't make sense to me how they don't have email, but perhaps, I'm just being too naive about it. Maybe there's people that just don't have email out there, but yeah, it's just been a tough go around with this person. They habitually promise to pay and promise to do things, and they never commit to that date. And it's always either weeks and weeks and weeks after, or it just doesn't happen at all. And I've been doing it for 3.5 years now. I'm just so tired of it. I'm just like, it's just broken promises. And
that's where you got to just drive them to either just reinstate or not.
Yeah. I mean, they're
But
already
then I have borrowers like that
hole.
where they'll reinstate when they have to.
Yeah.
And then you'll do it again. I got one guy I've started foreclosure on like literally 4 times.
I got a guy pays once every 3 months. Is what he pays. So that's just the way. And he's been. I knew that going in. That's what he was going to basically do. So, but he knows the 90-day mark is when the hammer comes down. So, Justin, can you not instruct FCI to not accept that or put it in suspense in a suspense account until everything is paid up at that point?
I did not accept those funds they sent in late to reinstate, and it wasn't even enough to reinstate it. It was still $750 short to reinstate it.
Yeah.
So I had been paying for forced place insurance for 3 years, and I've been paying taxes for 3 years for them, and they're not getting it caught up. Like, they'll just make their regular payment. So they do have instructions now to not accept any more payments unless I authorize it.
Right.
According to, I think it was FCI that said this, or maybe it was my attorney, is that they legally have to accept a payment until it hits this, I think they call it like a pre-foreclosure phase, however they define that. And then once it hits this pre-foreclosure phase, then they can legally say, no, we don't have to accept the payment unless the investor or lender says to accept it. So it took me a while for them to get that far behind to make that happen.
Gotcha.
Because they were smart enough. Maybe they were smart enough to start paying at the 75 or 85 day window. So just before that 90-day, magic mile marker, if you will, to where, okay, now you don't accept it.
I bumped into a new one recently. So I had started a couple foreclosures. I've had a couple loans where the borrower's been making payments every month, but they will not pay the property taxes. And so I have one where I was actually able to start the foreclosure just because of the property taxes.
It's not non-monetary default.
Yeah. And so this one guy went bananas and decided to fight it. I think he probably used ChatGPT to write this stuff, but he basically wrote all these letters like to the attorney and the servicer demanding like proof that he has to pay on the loan. Like, now he wants to pay nothing and he stopped making payments.
Oh, good.
He thinks he has a right.
That's to our advantage, to your advantage.
I guess. Yeah. So my attorney was like, okay, do not communicate with this guy. Like, we'll handle it. So now we're going like back and forth, responding to all of his crazy requests for different things. But yeah, it's funny though, because the guy doesn't realize it's like, even if I said, hey man, you win, I'm going to write off the loan, he's still going to lose the house at some point when he doesn't pay the taxes.
That's right.
So I'm not sure like where he's going with the whole thing. So
that sounds like one of my tax liens that I purchased a number of years ago, where the guy was rebelling that, I forget what he called it, that he no longer owed property taxes and everything. I have to
like a sovereign citizen or something.
Yeah,
like
there you go.
those,
Yeah, it's one of those guys is what it was.
It's like I talked to Wesley Snipes. He said I don't have to pay these taxes.
Yeah, exactly. It was or something sovereign, and you don't have to pay, or something along that line. And I mean, the guy eventually, the courts basically just kicked it out. But I'll tell you, he kept refiling, and the judge got so ticked off and that barred him from being able to refile on this case anymore. And then after that, we finally got everything. Things finally quieted down, but it took a year to get through all of it. So
there are a lot of people that do not like to pay their taxes. I've had borrowers complain to me that the tax bill was too high, like it shouldn't have gone up, and then the interest and penalties were too severe. And I'm like, lady, you got to talk to your county about that. Like, that's between you guys.
We have no control over that.
I have nothing to do with that.
2 guarantees in life are death and taxes.
Yep.
Yeah.
and making your mortgage payment.
But it's funny too. Like I had another one, like you mentioned earlier, Justin. Sometimes people like get tax returns and then get caught up, so default rate goes low. A couple of months ago, I had a conversation with a borrower who was behind, and I said, "Oh, well, tax season's coming up. Do you have like a refund or anything like that?" He's like, "Oh, well, I've been on disability, so I don't file taxes anymore. I haven't done that in a few years." So I'm like, "Okay, great. Like whatever. Like for that, okay, great."
One of those guys, huh?
Yeah.
Listen,
Like fantastic.
You got nothing you can garnish.
this borrower I was talking about a few minutes ago where they were so far behind, they're like 14, 15,000 in the hole now just to get caught back up. They have so much equity in their house. They have like, I think just a little over 50% equity in their house. Like,
Yeah.
I'm just like, why don't you just sell the house, walk away with cash and go put it towards a down payment on something else that maybe is more affordable? Like,
I got one just like that, Justin. I mean, it's at one time it was a $300,000 house. I don't know what it looks like on the inside, but even if it's only $250,000, they only owe like $100,000 on it. But now they've racked up. This is the one that's in Texas. It's in foreclosure. They've racked up $14,000-$15,000 now. That's they've got to pay if they want to stay in, and it's like, just sell the stinking house, fire sell it, and you're still going to make money.
Yeah, it's like I got my guy that I started foreclosure on 4 times. I got this notice, and he was getting behind again. So like my strategy has been, look, I just want to, and the dude's his payment's only a couple $100, and when he reinstates, it's always for like 7,000 or 8,000. So my strategy is just to try to let him get like so far behind that eventually like he doesn't make the reinstatement, and I get this thing closed. But a little while, not that long ago, I got this letter from the IRS, and it had to do with some IRS case with him. I'm not sure why they sent the letter to me because it had nothing to do with it. So I had the dude on speed dial. So I texted him and just said, "Hey, heads up, like we got this letter from the IRS. You might want to go talk to them." And he goes, yeah, thanks. But I think he got confused and thought it had something to do with the loan, because then he made a couple $1,000 payment and got it caught.
Well, hey, nothing wrong with
he was like sending me statuses on the IRS thing, and I'm like, I really don't care. This doesn't. I'm just letting you know, like just in case.
IRS lien is probably what's happening.
Yeah, but then he made a big loan payment and I'm like, okay, like whatever. Okay,
we'll take it. It's all right.
Yeah. I mean, I don't think you could lose interest in a loan due to an IRS lien, could you? Maybe you could eventually.
I don't think so.
I don't think so. They can garnish. They can certainly seize his. Well, they could potentially seize his assets. That is true.
Yeah. Or I guess
I've
if they were
happen, but maybe it is allowed to happen, but I've not seen.
Yeah, I've never heard of that. I mean, I could imagine if there was like a criminal thing where he seized his assets, you could probably be SOL. If the feds took the house.
They could force him to sell. If there's equity, you would get paid first, and any equity the IRS would grab. That they could potentially.
And there is a lot of equity. So
the one good thing about foreclosing in states that can do it quickly is that even if the borrowers have a significant amount of equity in houses, sometimes they don't have enough time to get the house sold in order to get it paid off and for them to cash out before a foreclosure sale. I just had that happen with actually a decent sized land tract that I foreclosed on in Tennessee. And the borrower's got a good amount of equity in there. He just couldn't sell it. He or she couldn't sell it on the MLS fast enough before the foreclosure sale because it only took, I want to say 60 days.
I was going to say Tennessee's
pretty
quick. I've only done one there, but it was super fast. Like my attorney, like literally like gave me a schedule and it followed.
I think there is a redemption period in Tennessee though.
Oh, I'm sure there is if it forecloses that fast.
Yeah. Mine sold at auction and I got paid. So
I'll have to look that up.
I think for some reason I'm thinking it's a year redemption period in Tennessee.
I'm not worried about that because this person, they got foreclosed on because they literally admitted that they just don't have enough money to pay it, and they were trying to figure out what to do. And I'm just like, you need to sell it now, like hurry up and sell it because I can't stop the foreclosure. Like,
No.
it's just, I can't stop it now. It's already going.
Yep.
So, yeah. I don't think I've ever experienced myself, and I don't recall of anyone else experiencing to where someone has made up the redemption in that time period in any state.
It's rare.
I
It can happen, but it's rare.
Yeah.
I had one in Michigan, but I'm trying to recall if that was a reinstatement before we got all the way through, or if she had actually redeemed it. It was like really borderline. It was like at the last minute.
I've got one that's like that right now.
Yeah.
So in Michigan. So we're coming up.
6
Deadline's
months.
June 15th. So we'll see what happens there.
6 month redemption.
Yeah, a 6-month redemption.
Yeah, three if it's a land contract.
So you're just holding it as an REO until they redeem it.
Well, you don't get the deed until 6 months. So although it's foreclosed on, I don't get the deed until the 6 months is.
Yeah. So when I did
it's
mine,
passed.
That's right.
you know, which was different because it was a land contract that was already on the deed,
You already had
and
the
it was
deed,
only
yeah.
3 months. Basically, I just had to sit and wait.
Yeah, that's
for
all
3
I'm doing,
months.
sitting and waiting.
I could have tried to market it earlier, but I couldn't transfer the deed
Correct.
until then. And then if I did make an agreement to sell it and the borrower did come back and redeem, then that's a mess, you know, so
That's a
we
big
just wait-
mess.
we-
Yeah,
we
you
just
just got-
waited the 3 months and,
They just get a free ride for 6 months or 3 months, depending on whether it's land contract.
well, it was vacant, you know, she was long gone, but
Well,
she
I
just
still
had
got
to
people
sit
still
there.
living in it.
Jeez. And
So
then you
they've
get
gotten
another
a free
6
ride.
months of eviction.
Yeah, exactly. So she's trying to fix it up because she wants me to sell because there was multiple people on the loan. She wants to stay there. She's fixing it up and cleaning it out, and she wants me to essentially sell it to her on terms that she could afford it. She can afford it. So we'll see what the house looks like, though. It's got to get way better than what it was. Dan, so you know, once the you do have the right to do an interior inspection once the foreclosure is done if you suspect that there's anything that is being damaged to the house. You can accelerate that redemption period.
Oh, if they're
Even if they're in
still in there,
If they're still in there and they're doing damage to the home, you can get that accelerated in the court. But you are allowed to do an inspection legally. So
yeah, in my case, it was vacant, and so we had to secure the property and winterize it, and you know, so we did all those inspections, and everything.
How
we'll
does
see how
that
this
work,
plays
Jay?
out.
If somebody's in there, is it like a sheriff that goes in and does inspection?
No, the attorney contacted them and say the courts have allowed us to do this, and you set up a time. And I had a realtor go in and take pictures and everything. I hired a realtor to go in and do that. So
I had one in Michigan. I thought it was a deed of trust, but perhaps it was a contract for deed. And it was an older guy, and I think he survived his wife. His wife passed, you know, maybe a year or two before. And he stopped making payments, and so we had to foreclose on him. And so we were sending the property inspection person to the house to inspect the property to see if they were there, and they were there, and they were remodeling the house. And we're like, and so I told our servicer, like, hey, you might want to tell them, like, you probably should make your payment and not remodel the house, because all you're doing is adding value to me to make more money. Like, you should make sure you understand that. But apparently he was at the age to where he was just not making sound decisions. Yeah. And they had to have a guardian ad litem, you know, help them with day-to-day stuff. And even with the guardian ad litem, they still had to get the sheriff involved to get the guy to understand, like, you can't stay here anymore because you haven't paid for 2 years. Like I don't know what to tell you. Like, everyone's like, he went to court like 2 or 3 times, and they kept, you know, doing a continuance because, you know, they needed to find this guy a place to live. I felt bad. I'm just like, man, this thing is dragging on forever. Like, I don't know what to do. It's like, I have to get this back, but he left all the stuff there. Yeah. So we were required to leave it all outside for a period of, like, I want to say it was 24 to 36 hours for him to come by or them to come by and pick up stuff. And they only picked up like a couple of things, and they left most of it on the driveway. So then I had to have a company, you know, haul it away. and hope that other people would just, take it off the driveway for me. It was a really weird situation. I still can't believe that guy did the remodeling on, like, he did all new windows in the house and stuff. I'm just thinking, like, why would you pay your mortgage? Like,
Would do that.
I don't get it. Like,
People do weird stuff. Yeah.
Well, I was gonna say I may have one like that we're just starting foreclosure on right now. He's an older guy. I mean, the payment's like $334 a month, and you're telling me you can't pay that $334 a month?
Yeah.
Okay, and it's like he's gradually gotten further behind. And it's like, no, I'm not tolerating this. So we're going for it, and we'll see what happens.
All right, guys, we're about out of time for today. So thanks for hanging on the call. It's good conversation today.
Yeah.
There's a lot going on.
The real world of mortgage note investing. There we go.
The war stories behind the stories, right? So that's a more good than bad. I know we talk about the bad stuff because that's the stuff that you learn from the most.
Yeah,
way more good stuff than bad stuff. So, anyways, thanks for joining the call today, and comment in the comment section on whatever you're watching this replay on, and we'll be happy to chime in and answer your questions. Take care.
All right. Bye-bye.
Yes.